This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this is the second lecture on the management of cash. And I said at the end of the previous lecture, as far as calculations are concerned, there are three things to be aware of. The first of which, and by far the most important in practice, is cash budgets. That you should be aware of budgeting in general from earlier exams, but so important is a cash budget, budgeting usually monthly, how much cash we think we'll receive, how much cash we'll pay, and therefore what we expect will happen to the bank balance, the cash balance, so that we can identify months when perhaps we're going to have surplus cash. Then we can plan ahead what we're going to do with it. And even more importantly, we can identify months when we're likely to be short of cash. And then we can decide how we're going to cope with it. You know, think back to the last lecture. If we know we're going to be short of cash in 3 months' time, you know, can we delay capital expenditure? Shall we delay dividends and so on? So, terribly important. And on the first, well, not the first page, but at the section 5, you've got a pro forma cash budget that, as I say, we normally will do it monthly, the next 6 months, the next 12 months or whatever, where we list what receipts we expect, what payments we expect, and then month by month, what cash surplus or deficit we expect. And we can use that to forecast what the cash balance will be at the end of each month. And to show you, have a look at on the next page at example 1. You're presented with the following forecasted cash flow data for the organisation for the period November X1 to June X2. It's been extracted from functional flow forecasts that have already been prepared. So we've been doing budgets, budgeted profit statements and so on. And the information we've got from there, well, we've budgeted on what the sales will be from November X1 right the way through to June X2. We've budgeted what the purchases will be, the wages, the overheads, the dividends, capital expenditure. So we've got all that information from our profit budgets. Now we're also told sales are 40% cash, 60% credit. And sales on credit are paid 2 months after the month of sale. Purchases are paid the month following purchase. C, wages, 75% of our wages are paid in the current month and 25% in the following month. Overheads are paid in the month after they're incurred. Dividends are paid 3 months after they're declared, after they're announced. Capital expenditure, we pay 2 months after it's incurred. We're taking 2 months credit. And the opening cash balance is 15,000. The managing director is pleased with the above figures because they show sales will have increased by more than 100%. Look at the sales figures. November 80,000, the following June we're budgeting on 180. And the bank, back to managing director. In order to achieve this, he's arranged a bank overdraft with a ceiling, a limit of $50,000 to accommodate, to cover the increased inventory levels and wage bill that we'll have for overtime worked. And we're asked to prepare a cash flow forecast, a cash budget for the 6-month period, January to June. And then we'll comment on what results we get. So let's set it up. Standardly columnarly, we're asked to do January to June. So January, February, March, April, May, June. And let's first of all go through what receipts we expect. Well, the only receipts mentioned are going to be the receipts from sales. And we know how much we expect to sell each month, but note A tells us that the sales, 40% of them are cash sales. 60% of them, though, are on credit, and credit sales are paid 2 months after the month we sell them. So customers are taking 2 months credit. Whatever we sell in January on credit, we'll get the cash 2 months later, February, in March. So let's do it. First of all, what are the receipts from cash sales? That's easy enough. Cash sales, you'll get the money in the same month. And so in January, the sales are 110,000. 40% of them are cash, and so 40% of 110, 44,000. The rest of January's sales are on credit. So the other 60% of 110, January's sales were 110,000, 60%, 66,000 are on credit. Well, we sell them in January, but we get the cash 2 months later. We'll get the cash in March. And similarly, February sales, 130, 40% are cash, so 40% of 130, 52,000. Sell in February, get the cash in February, but the other 60% will be 2 months later. 130, 60%, 78,000. Sold in February, 2 months later we get the cash in March. March's sales, 140, 40% in cash, which is 56,000. The other 60%, which is how much? 140 times 60%, 84,000, 2 months later in May. April sales, 150, so 40% is in cash in the same month. The other 60%, which is what, 90,000, 2 months later in June. May sales, 160, 40%, 64,000 in cash will be received in May. The sales on credit, we're only doing the cash flow forecast up to June. And so May's credit sales, the cash won't come until July. For our purposes, well, we're not going up to July. But similarly, June sales, 180, 40% in cash in June, which is 72. However, as you may have realised and been waiting for, in January and February, we'll be receiving cash from credit sales from the earlier months, November and December. That's why the information's given. You see, in November, we had sales of 80,000. Some of that, 40%, will have been received in cash in November, but we're not doing last November's cash flow forecast. But 60% of November's sales, which is 48,000, received 2 months later, December, January. So in January, we'll get 48,000 from the previous November's sales. And similarly and finally, the sales in December, 40% were cash and we'd have had the money in December, but the other 60%, 60,000, the cash 2 months later, December, January, which is February, which is in the period we're looking at. So there are the forecast cash receipts. They're the only receipts, so the total receipts we're expecting. In January, 92,000. In February, 112. In March, 122. April, 138. May, 148. And finally June, 162. So those are the cash receipts we're forecasting. Now let's look at the cash payments. And let's do them in turn. In the top table, we're told what purchases we expect each month. But if you look at B, purchases are paid the month following purchase. So we're taking 1 month's credit. So November's purchases will be paid for in December, but we're only doing January to June. December's purchases paid 1 month later will be in January, so we'll pay 60,000 in January. January's purchases of 80 will be paid for in February, and so on. February's 90 will be paid in March. March's 110 paid in April. 130 following month May, and May's 140 will be paid in June. June's purchases won't be paid until July, and we're only doing the forecast for these 6 months. What about wages? We know what the wages bill is each month, but note C says 75% are paid in the current month. The other 25% are paid 1 month later. Well, I won't waste time doing separate workings. I'll do it as 2 lines. 75% is paid in the current month. So January, the total is 16,000. 75% of 16 is 12,000. 12,000 therefore will be paid in January. And the other 25%, 4,000, will be paid the following month, February. February's wages are 20. 75% of 15,000 will be paid in February. The other 25%, or 5,000, will be paid in March. March's wages, 24, where are we? Yes, 24,000. 75% is 18, paid in March. 25%, or 6,000, in the following month. April, 75% of 28 is 21,000, paid in April. The other 25%, 7,000, in the following month, which is May. May, 75% is 24,000, paid in May. 8,000 is the other 25% paid in June. And June, the bill is 36,000. 75% is 27,000. The other 9,000 will be paid in July. We're not doing July. Finally, though, of course, I need to go back to the beginning, because a bit the same idea as we had with sales receipts earlier. The wages bill for December, X1, was 12,000. 75% of that will have been paid in December, and we're not doing December's statement. But the other 25% of December's wages will be paid for in January. So December's wages were 12, 25%, 3,000, would be paid 1 month later in January. What else? Overheads. We know the expense each month, but when are they paid? Well, D says overheads are paid the month after they're incurred. So in January, we'll be paying December's overheads, which were 10,000. February, we're paying January's overheads, which are 15. March, we pay February's, which are again 15. April, we pay March's, which again are 15. May, we pay April's expenses, which were 20. And finally, in June, we pay May's expenses, which again are 20. That's a nice easy one. Dividends are 20,000 and 40,000, but look at note E. They paid 3 months after they're declared or after they're announced. So the dividend that was announced last December of 20,000 won't be paid until 3 months later, which is when? January, February, March. So in March, we'll be paying that dividend of 20,000. There's another dividend of 40,000 in June, but if it's declared in June, it's not going to be paid until July, August, until September. Well, we're only doing the forecast up till June. Finally, capital expenditure. New machines, etc. 30,000 and 40,000, but note F, we pay 2 months after it's incurred, so we're taking 2 months credit. So if we have capital expenditure of 30,000 in January, we'll actually pay the cash 2 months later, February, March, which is March. I'm getting lost in March. And finally, 40,000 in April. It'll be paid 2 months later, May, June. We'll pay 40,000. The cash will be paid in June. So we've got all the expenses, the payments there rather. So what's the total payment each month? In January, 85,000. In February, 114,000. In March, I better use my calculator to be safe. 90 plus 18 plus 5 plus 15 plus 20 plus 30. 178,000. In April, 110, 131. Oh dear. 152,000. May. $181,000. And finally June. $235,000. So we now know our budgeted receipts, cash payments each month. What's the net surplus or deficit? In January, received 92, pay out 85, so a surplus of 7,000. In February, receive 112, pay out 114, so a deficit of 2,000. March, 122, pay out 178, a deficit of 56,000. I don't know if it'll be March. April, 152 out, 138 in, a deficit of 14,000. May, 181 out, 148 in, deficit 33,000, and finally in June, 235 out, 162 in, a deficit of 73. We need, though, to forecast what the bank balance will be, the cash balance will be each month. It does tell us in note G that the opening balance is 15, so the balance brought forward 15, and therefore surely at the end of January, well, we had 15, there's a surplus of 7, and so the balance carried forward at the end of January will be 22. Come to February, well, of course, February starts with 22,000 now. There's a deficit of 2, so the closing balance is 20. March therefore starts with 20, there's a deficit of 56, so we end up with a negative balance of 36. April, we start with an overdraft of 36, deficit of 14, so we end with an overdraft of 50. May, we start with 50, we end up with 83. And finally, June, we start with an overdraft of 83, a deficit of 73, so we end with an overdraft of 156,000. So there we are, there's our cash budget. It takes a long time for me to speak. It's actually very quick to do, and you're unlikely to have to do a full 6 months. However, that was the numbers bit. Part B, though, comment on your results in the light of the Managing Director's comments and offer advice. Well, his comment, all right, he's pleased that sales have increased. Fine. Obviously, that on its own is good. And we're not asked to do profit statements, but I'm sure, well, I'm not sure actually, but, you know, hopefully profits will increase. However, his other comment, he realised we were going to go overdrawn, so he's arranged an overdraft, but there's a limit on it of 50,000. And of course, we've got a problem in that we do go overdrawn. We hit the limit, though, in January, February, March. In April, so up to the end of April, hopefully we're okay. We're allowed an overdraft of 50,000. But we have a huge problem, of course, in May and June. We go way over the limit. And so there's the problem. And what are we going to do about it? Surely there are various things to consider. One, of course, would be to see if we can arrange with the bank a bigger limit. You know, we need a limit, certainly up to June, of 156,000. So see if the bank will allow it. If they won't, or alternatively, what can we do about it? It all relates to the chat I had in the previous lecture, that certainly the dividends, we could cancel the dividend. And if we cancel the dividend of 20, that would mean we only get a size 136,000 overdraft. We could consider delaying the capital expenditure. Both of them, because that would save us another 70,000. And we're getting much closer to down to the limit. The trouble with delaying capital expenditure, of course, is the extra sales will perhaps because we were buying new machines. If we don't buy the new machines, we save that 70,000, but maybe we don't get the extra sales as a result and lose cash that way. What else? We can try and get our credit sales to pay earlier. They're having 2 months credit. If we can pull it down to 1 month's credit, we get cash in sooner, and that would help the cash flows. Maybe offer them a little discount to get them to pay earlier. We could delay paying our suppliers. We only take 1 month's credit from suppliers, note B, but we're allowing 2 months credit to customers. So, you know, if our customers are taking 2 months credit, why don't we take 2 months credit from our suppliers? And delaying the payments by an extra month, that would help the cash balance, bring the overdraft down. Wages and overheads, I think you're unlikely to, your staff are unlikely to agree to you delaying paying wages. So not much we can do there, except, of course, try and cut expenses, wages and overheads. And finally, overheads, we pay them up after they're incurred. I think you're less likely to be able to delay payment of overheads. You know, if it's things like electricity, danger is if you delay too long, they turn off the electricity. But certainly, see if we can delay payment, because again, if we can delay payment, again, it would bring down the overdraft. But unless we do something, the company's got a huge problem, because again, once they get beyond April, they've completely run out of cash and they can't borrow any more, you know, unless we get the overdraft increased. Anyway, there we are. That's cash budgets. It's just reading carefully and speed. I don't think it's arithmetically difficult. I'll leave that there. In the next lecture, I'll look at the next technique, which is something called the Baumol model.